I'd like to introduce our panellists and invite them to come to the stage. We have from JP Morgan Global Natural Resources Fund, portfolio manager there, Neil Gregson. So Neil, please. We have Mark Burridge, who is the managing partner at Baker Steel Capital Managers. We have Carl Tricoli, who is joining us from Houston, I believe, today, from Denham Capital, founder and managing partner at Denham. And we have Hans-Arne Lorange, who is head of metals and mining at Clarkson Platou Securities. George Cheveley, you will see in your programme, was in the original lineup, but he is now taking part in the gold panel tomorrow morning. So please do join us for our gold panel at 9 o'clock tomorrow morning if you want to hear from George. But we have a great lineup here. The photos don't quite match, but it's all good. You can work out who's who. Okay, fantastic. So the purpose of this panel really is to sort of set the scene for the conference and to hear from some leading funds on where the market is right now and where we go from here. So, how has the year been so far? Neil, you fled down the end there, but I'm going to start with you.
Yeah, it's been fine actually. Looking over the last sort of 12 months, I mean, our benchmark is half energy, half mining, and it's up 16%, so it's slightly ahead of MSCI World. So obviously, a fair bit of that performance was driven by the recovery in the gold sector, some modest gains in mining, modest losses in oil. So I think given what's been happening in the world over the last 12 months with the trade tensions, weaker growth in China, all in all, and aside from iron ore and gold, fairly muted commodity prices. I think all in all, the last 12 months has been pretty good, but we would expect for sort of a modest improvement through into 2020.
The JP Morgan fund, what percentage of the fund is dedicated to gold?
We're about neutral now, so that'd be 20% of the overall portfolio.
And is that the best performing sector for you this year?
Yeah, I mean, year on year, if you look at something like the FTSE Gold Index, that's up about 40%. So I think the mining is up sort of 12, and the gold piece is down minus 6. So, but as we've seen many times in the past, when gold rallies, usually the rest of the commodity suite follows, and I think we'll sort of stay with history and expect the broader commodity suite to perform better over the next 12 months.
Hans-Arne, let's come to this end.
I think this is certainly a bit threefolded. If you look at e.g. Rio Tinto, that's the large major, have returned 20% so far this year, including dividends. So the majors are certainly doing very well. And the margins for those first and second quartile is very healthy across the mining sector, not just the gold sector. But it's really folded if you go into the junior area, because the market really lacking to provide the capital that a lot of the audience here is looking for, exploration and constructions money for juniors that want to go into production. So I think the market is at least threefolded. The big guys doing well, gold doing well, but market is very, very difficult for equity for the junior sector. And I think that how to address that and how to look that into the next year is a very sort of difficult question. If you look at transactions for the junior sector, it has been a terrible year. So it is at least twofolded.
But a terrible year is usually followed by a better year. Everyone tells me how cyclical this market is. So what do you think about the year ahead? I mean,
haven't you been saying that for like 3 years?
That's true. And it has been up and down. I mean, the gold has performed very well this last year. You guys are always very gloomy.
It hasn't really been a terrible year for us. I would say that probably 2/3 of our assets are focused on gold investments. So obviously it's been fairly good for us as a company. And I think, but what's more important is that increased cash flow for the gold companies is starting to deleverage some balance sheets and enabling them to start looking at growth options. And I think what we're seeing is that some of the growth options they're looking at are perhaps more disciplined, so they're not going to build billion-dollar mines at low returns. But what we are seeing an increase of is sort of selective investment by those companies into emerging companies with good exploration ground and those types of things. So I think that has actually, I think sort of the light at the end of the tunnel this year is the fact that some of the mid-cap and large-cap companies now have a bit of cash to deploy to perhaps for strategic investments or a bit more. So I think that's quite positive development in the gold sector.
I mean, Hans mentioned that the bigger companies are doing very well. Is it time for them to step up and start funding the junior space and the new exploration projects?
Well, I think that's perhaps where there's a real win-win in this sector. I think that when we perhaps only maybe 10% of our capital goes into junior companies as a firm, and whenever one comes through, as some people here might know, we say, well, have you run a process to see if a major will be, or not just a major, but a mid-cap company will be a strategic investor? Because we think that's a real litmus test for companies if their project has got any merit at all. So if you get an offer, it doesn't mean you need to take it, but it does show that at least somebody who's an expert who's been through the data thinks you've got something that's worth doing something with, and I think that's where the win-win is. You can end up with a system where you have a major partner take your project through. You can have selected equity investors like us, perhaps topping up a little bit on the side, and then you can avoid, some of the things like royalties and streaming, which do come with a lot of hooks, which aren't necessarily what you want to get yourself into if you're an emerging company. But sometimes you've had no choice.
Well, I guess one man's distress is another man's opportunity. So for Denham Capital being in the private equity world, this has actually been a good environment and opportunity for us as the public capital markets, as Hans mentioned, are not coming to the table necessarily with equity. That's provided us with some pretty significant opportunities to fund companies privately. And so for us, we see our deal flow increasing as companies look for particularly development capital for their projects.
What sort of companies are you investing in recently?
So we're a little bit commodity agnostic. We're probably mostly focused in base metals, but are also doing gold, some specialty metals. We just had a copper mine in Chile come into production about 3 months ago. We have a very, very large tin project in the DRC that is now up and running and in production. We're in some other specialty metals like niobium. So other than things like diamonds and bulks, we're a little bit, as I said, commodity agnostic. And generally, we're focused on companies that are, sort of PFS or later stage and are sort of ready to go into construction.
Fantastic.
Yeah, pleased to add in there that we see the majors investing. We've seen companies like Geology being sort of supported by South 32. We've seen SolGold being supported by 2 majors, and they're definitively willingness to invest from the larger mining companies that have cash. The other source of cash is certainly the private equity sector. We do see quite a bit of challenging in how the PE funds have approached the junior sector because a lot of the structures that have been provided have been structured as loan facilities with first liens and so on. And when the market is that difficult as it has been, that is the only source of money, there is a lot of hooks if a company have first lien facilities from PE funds that expect high tense return, at least 12 to 15%. What is the upside back from equity market then? And I think here is a question that we should all think about. How high return can mining projects provide when risk-free interest is 2%? Are you going to have 10, 15, or 20% risk capital on the top of it if you have first lien at 12 to 15%? I think here is a challenge in the capital structure going forward.
Yeah, and let me respond to that because I think it's important to distinguish between private funds generally and private funds that provide equity and private funds that provide structured debt. So Denham, for example, we are true equity. We are at the bottom of the cap structure. We would have debt if it was appropriate on top of us. There are others like that everyone knows, Orion, Sprott, Taurus, who provide debt facilities. But even in those cases, we need equity. So I would agree with the proposition that you have to look at how much the project will return in total to look at what the cost of the what the cost of the cap stack is. And if that debt is the only fund available, fine. But just to distinguish, among streamers and debt providers and sort of equity providers, all who play a different role in the capital structure.
I think that's an interesting comment because one of the things that you observe is that, particularly as companies come to the development stage, they've spent so much time, effort, and expertise, man-years and man-years of in-depth analysis and studies to prove up the reserves, design the mine, engineer it, de-risk it, all the things that you need to do. And then it all falls to pieces when the board needs to figure out its capital financing decision. That it's one or two orders less magnitude of rigor is applied. Options aren't explored properly. Some options sometimes are ignored. We see that, and that's probably the bit that I think companies can do better. Is you're doing a great job of advancing your projects, but really think intellectually and realistically about what the financing options are on the table and how you decide for your shareholders what's the best route, because we don't always see that. We see so perhaps too quick to jump to a high interest debt or a convertible debt or a stream or a royalty when there might be, like I said before, a mid-tier company who needs some production growth sitting right next door who's willing to fund you, and it might look in a holistic sense, those types of things sometimes are a lot less dilutive than the gut reaction of boards and management. So I think that's probably the main thing is companies need to apply the same rigor to their capital financing decisions as they do to their technical decisions. And I think there'll be a lot more opportunities for people like us and, a lot more financing for companies if they do.
Is it also important for those providers of alternative capital to make sure that the structure they're putting into the company allows for future equity fundraisings? Because I know there's certainly cases of companies who have taken on private equity money and then find it very difficult when they go back to the capital markets to do an equity raise. People say, well, it's got too much control in there from this private equity firm, I'm not going to see the upside. Is there a responsibility for private equity firms to make sure that they're
it is, and again, we probably need to distinguish among different firms and what they do. I think, to your point, I do think it's not particularly helpful if you have a sort of hybrid where a private equity firm owns a large chunk of a public company, and then that sort of creates a difficulty going forward in raising capital because you have this very, very large controlling shareholder. We sort of go the opposite end of the spectrum. So all of our companies are private. So we're funding everything. I mean, we're fully funding an entire development program for that company, but it's all done in a private context. I think the point is very well made that if you're in a public context, you have to be very, very careful about what layers you put in the capital structure and that not preventing you from raising capital in the public markets later.
Absolutely. Going back to the subject about sort of the majors and mid-tiers and producers who are generating lots of cash, putting money back into the junior space. Obviously, at the top of the last cycle, a lot of companies got into trouble and their CEOs got kicked out, often from investor pressure for making rash decisions. To what extent do you think companies are still fearful of making those mistakes? And what is the responsibility, do you think, of funds to encourage companies to actually take some of that cash and put it back into exploration and M&A?
I think we kind of still have the opposite problem, is trying to encourage the companies to spend their cash wiser. I think there's still a natural tendency for companies to spend their spare dollars investing in something rather than perhaps returning it to shareholders or anything. So I think it's more been a lack of capital for these companies because they still, certainly in the gold sector, gold companies have been paying down debts and surviving a sort of a modest gold price environment. So I think our biggest fear is that there won't be the right balance. So the large companies themselves, even the very largest companies, still have that same problem with capital allocation and decisions, that they perhaps don't apply the same level of rigor and interaction with investors that they need to make the right choices.
Yeah, I mean, I just sort of think it would be very interesting to see how the boards and the CEOs of these companies act the next time we're in a strong commodity price environment. Because at the moment, they're all sort of saying, take our generalist fund managers, I'm sure they're no different to any others, is capital returns, dividends, discipline. Don't build anything new, don't build anything big or greenfield. But these are extractive industries, so at some point you've got to build new stuff. And if you say you want to be counter-cyclical in terms of your behaviour, then they should be investing now. They should be supporting more juniors, getting into more development opportunities. So they're all acting in the same way, so they're not being counter-cyclical. And I suspect in the next strong commodity price environment that investors will be saying, well, where's your growth? We're not interested in dividends anymore. So, but we'll see what happens. Maybe the CEOs will change again.
Yeah, it's important for the majors to do that. The paradigm that existed for a long time was that the juniors, through their exploration efforts, essentially provided, the feeder for projects that ultimately then went up into the majors. And that paradigm is broken now because the market is not supporting the juniors in those exploration activities. And so, to your point, Neil, when we come to that next cycle, in order for them to have sort of a pipeline of projects, somebody has to be supporting those juniors, particularly in their exploration activities. I noted the first 6 months of this year, there's been the least amount of equity raised in the public markets for mining than in the last 15 years. And so we're definitely at a trough of support for these juniors, and somebody's got to do it, or we're going to sort of wake up, 4 or 5 years from now and find ourselves with a real dearth of projects.
Yeah, I would challenge Neil a bit, because I think we have a very healthy metals and mining market in these days. Gold is at close to 1,500, and gold companies do 40%. The bulk miners do very well, and all the large guys is really very healthy. The only sector that we see that is in trouble is thermal coal because of the competition from natural gas. But we don't feel it like that because, number one, the equity market for juniors is probably in limbo, and the equity market for the majors have taken down the multiples from probably mid-cycle 7 to 9 to 4, 4.5. And I think that's why we don't feel that the mining market are in the heydays. But if you look at, again, Rio Tinto, delivering bulk commodities at $30 a ton in China, receiving 83, 84, with Vale back in the iron ore space, it is very, very healthy. So it's a question, when will a portfolio manager like Neil and other in the public space allow these board and management to start to invest in exploration and junior companies? And from what we see when we're around with these portfolio managers, it's not going to happen in next year. They expect 40 to 70% of the return to go back to the portfolio managers, and they are not reinvesting those in junior companies. So the majors are not investing, and the portfolio managers are not reinvesting in the juniors. The juniors is back on going to the other gentlemen around the table here and find private sort of equity funds, natural resource funds that provide the equity capital.
I think my point is that, you know, if a company asks me, you know, have you got any advice? I would say, yeah, don't listen to portfolio managers. You know, I mean, even we think we have a reasonable sort of investment time horizon, 2 to 3 years, but we all know very well in this room that, you know, the sort of build and the long cycle nature of these businesses. So, you know, I think that's my main point really is there's a lot of good opportunities out there, and try and make more of them now and get a nice full pipeline for a better environment, and, you know, build when nobody else wants to build. Because they'll all start building at the same time again, and we know what happened last time.
What proportion of their profits do you think the bigger companies should be putting back into exploration?
I don't think it's a top-down decision. I think it's, you know, are there opportunities out there? They've got, as Hans has already made the point, you know, they've got they've got lazy balance sheets, they've got huge amounts of cash flow, but, you know, it's like stock selection, it has to be opportunity driven.
I mean, one of our fund managers at the Sydney conference last week suggested that it should be sort of divided into thirds, a third for sort of keeping the company running, a third for giving back to shareholders, and a third for putting into new projects. Does that sound about right?
I think it probably where it averages out, you know.
I was going to say a quarter for executive compensation.
I think that was in the first third. I think that was in the first third. A little bit for conferences, maybe as well. Let's talk a little bit about China, the trade war. Any thoughts on how that is playing out? Hans.
Yeah, I just come back from a trip down under and have been meeting 22 mining companies in production, where whatever they do is to dig out of the ground, put it on a ship and sell it to China. And I think the major picture is trade war, tariffs, and the discussions between the political leaders doesn't matter for them. That's sort of the major impression from all the larger Australian miners. They are more worried about steel margins and the growth in China, and they don't think it's a problem with the tariffs. They really said, you know, we get the cargo to where it's demand. If we have to ship it through Vietnam, who cares? The thing is, how is the growth, which again means what is the politics in China, what is the price of credit, and they really don't care about what the US are doing in this matter. So I think we should look more on what is the growth rate in China and what are their domestic production over commodities, because that is what's making the balance and price the commodities in the international markets. So that's the impression from 22 mining companies I've just met over the last 2 weeks.
Yeah, I think from our perspective, there are a couple of things that come out of that. First, we think the trade war is actually masking some fundamentals, which is the trade war is creating a perception of more limited growth, more limited global growth, which has had an impact particularly on the base metals in terms of the base metal prices. However, when we look at the fundamentals, we see a big supply crunch actually coming, particularly over the medium term, and as you consider electrification and electric vehicles, et cetera, and the impact on that. So we sort of see this as an interesting, that the trade war for us, the major impact is that it's actually depressing prices right now at a time when the fundamentals we think are much stronger than what we're seeing reflected in today's current, particularly base metal prices.
Do we have, at this stage, because I've got a few more questions to go, but do we have any questions on what we've been discussing so far from the audience? One at the back there.
Thanks. with China, do you guys see that the Hong Kong and the battles that are kind of happening there affecting potentially the metals markets? If there's insecurity with China and insecurity with Hong Kong and trading, do you see that that'll actually affect the gold price and the other commodities? What do you see your outlook on that?
I mean, there was a new bill passed through the Senate, I think, it's waiting for Trump's signature, saying that there'll be sanctions, more sanctions if they don't do certain things in Hong Kong. So that's probably not going to help things clear up.
Yeah, I mean, instability, it's not just, it's not just Hong Kong. I mean, we see this in Hong Kong and Chile, in spots around the world. I think there is a general perception of instability, which obviously all feeds into the notion of more limited growth. But again, we see these things as, all of these things as sort of masking the more fundamental facts of, a dearth in supply. Everyone knows, you look at decade on decade, copper discoveries are 77% less than they were last decade. Everybody knows the story of diminishing grades, et cetera. So we think we're very bullish on the fundamental story, and all of these sort of things we think have a temporary effect of sort of depressing prices, but we think it's temporary.
Yeah, I think I would concur. Certainly for certain metals, there are long-term trends that can't be met by easily to build production. But this period of geopolitical tension also masks, whether it's Hong Kong or trade war or Brexit or political polarization, is masking perhaps some the economic imbalances and perception of economic imbalances, which is a bit of a risk globally, because those are the kind of things that can escalate, lead to a big economic downturn. But I don't think it's all doom and gloom, because there's definitely a way out of all of this in terms of growth. And some of the silver lining here is that this secular trend towards green energy, I think, seems inevitable, regardless of what else is happening in the world. And that is going to create demand growth for certain metals, from copper to cobalt and lithium. So we may be in a bit of a slump for those right now, but I think, that is an inevitable trend that will happen. I think it does create opportunities for companies. And I think probably the best thing to own right now would be a copper gold mine, because you've got gold as your hedge against financial issues, and you've got copper in case green energy electrification takes off.
I mean, that brings up a good discussion point. Is which commodities do our panel think are going to be the winners for 2020?
Can I just shoot in here, because when you called up and put up the agenda for this panel, you also put in what is going to happen with interest rates. And I think that's quite interesting here, because we have probably Europe going in the direction of recession. Maybe we had some good figures temporary from Germany, but Europe looks to be in recession, and people are worried about Brexit. We have China that is in the impression that it not growing anymore, but it is growing with 5% plus. And then we have the American economy, which is fueling on all throttles. I mean, the unemployment is low, the taxes is low, and the economy is doing very well. But what we see from a macro perspective is that we will keep interest rates very, very low for the next 2 years, which again should not support gold if gold is a hedge against inflation. So I would say that what we will see is the commodities that goes into electrification and renewables. The only really obstacle I get on this phone this morning, and I was not unpolite when I was looking at it, World Economic Forum today, this morning, announced that the president or leader in China has said that the next 5 years economy plan will focus on more coal and stable energy, which is contrarian to the plan for 16 to 20, which they now is implementing for 21 to 25. So from the macro perspective, it should be all the commodities going into the battery and electrification space. But what China tells us today is that they will still need energy from coal to have secure energy, because the new energy is unstable and it's growing too slow.
But doesn't that requirement for stable energy, isn't that fueled partly by the knowledge that they are going to electrify transportation, electrify cars, and you need a stable, grid supply in order to charge these things? And in China, that hundreds of thousands of cars are rolling off the production lines every year.
Yeah, obviously not. I think the pace of EV sales is slowing down in China now, and if you look at the recent data, we've finally seen a pickup in sales, I think plus 5% year on year in combustion engine vehicles in China, and we're seeing a pickup in sales in Europe as well. So.
Is that going to be offset though by these new lower cost models rolling off the production line? I saw one the other day for $8,000 or something. You can buy this EV now. Obviously sales fell because of the end of subsidies. They cut the subsidies on these things. But now you're seeing these cheaper vehicles coming back. You're hearing about people bringing subsidies back in again to try and promote them.
I think the base load though on the combustion engines is still large though, and I think they recognise the sort of damage they're doing to that established industry. So I think yes, I'm sure the trend's going to continue, but just slow down a bit.
To go back to the question about which commodities are going to be best in the year going forward, Carl, do you have any thoughts on that?
Again, our time horizon is a little bit longer. We have sort of 10-year funds that we're investing, so we are. Top of the list is probably copper, tin behind that. We like the base metals generally, as well as some of the specialty metals that will go into electrification. We do think that the pace of electrification will be slower than people think it is, but that on the other hand, it is also somewhat inevitable. Angela Merkel announced, a couple of weeks ago about a goal of by 2025 having 1 million charging stations, for example. In Germany, there are 20,000 at this point. So, when you look at the longer term trends of where car manufacturers are going in terms of their design, and you have to develop the infrastructure. So I agree, there's sort of this short to medium term where you're sort of in this transitionary stage where you're going to continue to have internal combustion engines. But I think when we look at a longer-term time frame, so things that feed into that, it's a little bit unpopular, but metallurgical coal, there's like 80 tons of metallurgical coal that goes in a windmill to produce a megawatt of power. So all of those things that feed into that, I think eventually those are the places that we like.
Mm. And copper as well.
Copper at top of the list, yeah.
But Leo, are you asking about what commodity are going to do well, or are you asking what commodity stocks that is going to do well? Because it's not necessary that is sort of going synchronized. Stock market used to be ahead of the underlying markets, and if I should sort of say, what stocks are you going to put your bet on if you are taking high risk and be speculative? Well, you should buy the lithium stocks. They were hit by going down 90% over the last 2 years, and the electrification and the EV is certainly long-term happening. The stock market probably is taking the turnaround here far before the market is turning and the oversupply is gone away from the underlying market.
Does the same apply for cobalt as well? That was also very hit.
I don't think that the car manufacturer is going to gamble to be dependent on DRC and Glencore. So I think that you should look at nickel if you go that avenue.
Mark, any thoughts?
Yeah, well, I mentioned copper and gold before, so I think we've had a lot of comments on copper and lithium too. I think that's a very good point that you make, Hans, because I think it is oversold for something that structurally is going to be required long term. But we think actually the low real interest rate environment is actually supportive for gold and provides for us a base. And I think that we are very constructive on gold over the next few years. We think that the underlying macroeconomic imbalances that are creating this geopolitical tension aren't going away anywhere. There's escalating debt, there's low real interest rates, and if you look at what can happen to come out of this, you need to grow yourself out of this within, which will drag inflation along with it. And the secular trend for gold is actually wealth generation, not economic crisis. So, and then on the flip side, if we do go through, more geopolitical tension and financial issues, then I think gold is quite positive. So we think gold right now is a very good hedge. On a 10-year time horizon, will it be the best performing commodity? I don't know, but it's certainly something that's, I think, a very good hedge alongside something like copper in a portfolio and lithium.
And
Mark, I circulated some slides to the group here in front of the panel in preparation, and we agreed not to use the slides, so that's okay. But I had a question there, and you're picking up quite good on it. If you go back to the period of 2002 to 2011, gold was moving from about 300 to 1900. And we should probably have the best conditions ever for gold again, and it's not just go from 1200 to small 1500. And who in this audience really want to be the large buyer of gold bars to put into Fort Knox? No one really needs it. So being the question, why should you buy a commodity that is not consummated? I think that industry minerals, base minerals, and minerals in general that are consumed is what's going to gain, that there is still a lot of people in China that is going to have more wealth, and Africa and India is coming. They're going to consume something, and I think that's the sectors that you look at. So to sort of put out the question, who is going to buy the next gold bar to put it into a safe in Switzerland or Fort Knox?
It could be me. I mean, I remember when I was at Credit Suisse many years ago, we had a group there's a group of us from Credit Suisse had a meeting with, I can't remember his name now, it was at Pemberton, but one of the retired Bank of England executives, talking about this, that and the other. I asked him about gold, and I said, look, if there was a big fire and all the gold melted and disappeared, would you replace it? And he said, no, there's no use for it. It was around the same time that sort of Gordon Brown sold all our gold at $260 an ounce, and I went. Where's a big jewellery place in London? Anyway, I went and bought myself a 4-ounce gold bar for $265, $270 an ounce, and it's still there today in my sock and pant drawer at home. So, and I'm not, I've been sort of investing in the sector for nearly 30 years now. I've never been, sort of like a raving gold bull. I still, the fact that today's price of wherever it is up multiples from then is just testament that it still has qualities and still has a use. And as long as there are people on this planet, I still think there'll be interest in gold. So.
Yeah, I think, Neil makes a good point. Gold is an enigma, and certainly for all of us have been in this business for a long time, and every several years or every few years, those questions get raised. What use is gold? And I think it's so embedded in human and financial psyche as an asset of worth, as are so many things in human nature. We apply worth to things that defy logic sometimes. And, I think that's the case with gold. And I think what's important about gold is that actually those questions were being much more intensely 2 years ago. But in the last year, we've definitely seen that pick up in people, reestablishing their own interest in gold as that diversifier and as that hedge. So I think, I think valid point, but gold will always be an enigma, and it will always be worth something to somebody.
Can you go for a precious metal that is also consumed, though? I mean, silver or PGMs?
Silver PGMs, in a way, silver's a very interesting hedge on that, isn't it? Because, it's over 60% of silver is used in industrial uses, but it also responds directionally, at least, to gold. So, you could argue that you could say, look, PGMs in these combustion engine, again. So I think there's interesting, those bridge metals like silver and PGMs may be a good way to balance between the enigma of the lure of precious metals and something that's useful fundamentally for society.
Yeah, and as the panel people know I'm ordinarily coming from the gold industry, and I'm not negative to gold, but I think the question is quite valid because we have seen central banks, as others, selling out the gold, and we have seen central banks in Asia buying gold as a part of their portfolio. But it's always a question, what will give the best returns coming up? And from our point of view, we think that it is the industry metals and silver that is going to be consumed, that will be leading, and which you really can buy on a very inexpensive price in the stock market today.
You've mentioned baseload energy earlier on the panel here. One of our panelists in Sydney suggested uranium was ready to have its time in the sun. Any thoughts on that?
I'm sure I mentioned that 4 years, 3 years, 2 years ago, but our worry about that is, do we need any new uranium mines? Because it sort of appears to us that with the Kazakhs and Cameco, that should we see an uplift in the contract price, that there's basically plenty of spare capacity. So we're not so sure if we get to, on a sustainable basis, let's say a price of sort of $60 plus per pound that's needed for many of these uranium projects out there. And obviously we've got a lot of these companies that were created in the last sort of uranium bull market, and they're still around. So I'm not sure if we need, certainly in the next 10 years, any new projects. But for sure, there'll be times when the spot price goes up and everybody gets excited again. I'm sure the stocks will do well, but we're a bit worried about where the longer term price is going to be.
Do we have any more questions from the question down here? All right. Do we get a microphone?
Yeah, hi. You started the panel this morning sort of saying how well all the majors had done, which is true, and how obviously badly the juniors had done. But a lot of the driver for the majors, if we forget about precious metals for a minute, has been iron ore, I guess. Iron ore has been very different, really, to all the other industrial metals, probably because it's an oligopoly, and it's an exercise in just how well these majors run an oligopoly, and they've been helped also by Vale's problems in Brazil. So, I mean, I just wonder if it's actually true that industrial metals have done well. Isn't it really just that iron ore has done well because they're good at running an oligopoly?
Yeah, I mean, I think I'd agree with that. I mean, I guess my point earlier on was that sort of given that background that we've generally had weak commodity price environment unless we've had a supply shock. Overall, I think the sort of equities have, because of their health, have performed reasonably well. I mean, iron ore for us, we've always just thought about it as even if you go back sort of 20 years, Pilbara has just been a sort of 40% EBITDA margin business for them. Sometimes it's 60 or 70, but it's just a good business to be in for possibly. I couldn't possibly say that for some of the reasons you've pointed out. But I think we don't make aggressive commodity asset allocation. We just long only equity. I mean, currently we are sort of overweight base metals, particularly copper. That's been a consensus for a couple of years. So maybe it will be copper's turn next year.
It's a theme that I think is pointed out quite well. Most companies do have one division or one asset that disproportionately provides the cash flow that they then go and sink into another hole in the ground somewhere else that doesn't make nearly as much money, and that's perhaps one of the issues we have in this business as investors. So, and you do need to dig through that, and I think that there are, not just in iron ore, but there are copper projects, there are gold projects that generate great returns, enable big free cash flow distribution, and can sustain their production levels and growth. And I think, the challenge for investors is to find those projects, because they are out there, but they are few and far between. And if we find them, then you get the companies that can look really good on the back of that that small handful of great projects, and hopefully someone will bring the next one along soon.
Absolutely. More questions from the audience? Got a great lineup here of panelists here for you to tap into. So what advice would you give to junior companies looking to raise money and get their projects off the ground right now? Where should they be looking? What should they be doing? How do they make themselves more attractive?
Well, I think technical rigor and honesty about your project is really important, because certainly as you come to the investors, they will scratch beneath the surface, and I think it's important to do that. But I think what you can realize that each project, as long as it's a project of merit, whether it's early stage exploration or a development stage project, or a company that's got mine, each company has got a universe of investors that will look at that stock, and it's not all the same. So you do have to do things like come to one, because you'll meet a bandwidth of investors here, but you may not meet the particular investor for your project. So, and the thing is not, investors don't all fit in one basket. The three of us have completely different investment styles and portfolio return. So the chances of the three of us investing in one project here would be very unlikely.
Yeah, what we see clearly when we are engaged from companies to find investors, that the investors have certain boxes to tick off. And I think what number one is important for management and board in junior companies that are looking for money: be focused. If we have a management team that have 2, 3, or 4 projects, typically in Canada having one iron ore project, one gold project, and one base metal project, and take it up from the basket when the market is better, those sort of management will never get money from the investors anymore. Management and board need to put all their efforts into the project and to be complete focused. That's number one. Number two, be very, very realistic about what return and how fast are you able to develop the project. There is no doubt about that. The equity investors of the world that used to provide a lot of equity to mining companies, they tell us that the standard in the industry is delays and cost overrun. So that's the standard that the investors' impressions are. And we have to rectify that with be more conservative, be focused, and be sure that the geological information that you provide is correct. Because no investors can change what's in the ground. They can provide money, they can change management, but they cannot change the geology and what's in the ground. So be focused, have a good project, and be realistic how fast it's possible to develop it.
So I would completely agree with those things, particularly on the technical rigor and conservatism. And the thing I would add to that is to broaden the horizon of capital sources. I think the paradigm that historically has been true of, sort of taking somebody and walking them around the city and sort of filling out your equity raise, that paradigm is changing. But there are other capital providers that are coming into the space. And so I think what I would say is if you have a good project, to sort of broaden the search of capital options, because just the paradigm of how capital is formed within the mining space is just changing. And so sort of keep an open mind and, broaden out your search.
We've got a question in the middle here. 2 questions.
Actually, just following on what you just said, Carl, I'd like to ask the panel what they feel about what seems to be clear in the sector over the past few years, which is that the amount of money that's being actively managed to invest in companies like the companies that are coming to this event is falling. And what I would be interested to hear from you, who are really at the coalface of managing that money and acquiring new portfolios but new investors, whether you see any sign of a pickup in the amounts of money that you or your competitors are managing or might manage, or just any trends in that area? That's really a question to all of you.
Yeah, I mean, we've actually seen a huge tick up in the money that we've received to manage over the last couple of years, but it's been matched by other funds that we know have fallen by the wayside. So, I think in the fund management side, let's say long equity listed funds, I think definitely there's less money available as there was. But I think the overall pool of capital available for the sector probably hasn't shrunk by that much. I mean, we're seeing, there's more money in the private equity space has come in over the last few years. I use that term very broadly because I know not all private equity investors are the same, but for the sake of lumping Denham and Orion in the same basket, I'll say private equity. CDs, So I think, and also, there is this deployment of money by mid-cap and majors, and you shouldn't just get hung up by the majors being the ones who invest in juniors. The mid-caps want to do it now. They might have one mine and limited exploration. They've spent all their effort building and financing that one mine, and they suddenly find they don't have a pipeline, and so they've got some cash flow to spend. So I think the overall pot of money is there. Family offices are looking to make a difference. We live in an environment of low yields, super high stock markets. The intermediate investors, what again lump into the family office basket, is looking for different way to invest in things. So if you add that all up, there's probably just as much money as there ever was, but it's the route to finding it has completely changed now. It's no longer you phone up your broker and he organises a placement for you. You need to have a multiple-pronged strategy that uncovers the right basket of money for you.
Fantastic. So keep an open mind. Look for many different sources of capital and keep coming to lots of conferences. So that's the key message, key learnings from the panel there. We've unfortunately run out of time. If you have any more questions for our panel, please do grab them outside over a coffee, and I'm sure they'll be happy to share some of their knowledge. But can I have a big round of applause for our opening panel?